hit on demutualization as an issue,
Yeah.
because I think
So,
it
I mean,
can cause challenges.
it can. And, as you mentioned, I've seen that with some of the policies that I own personally, as well as, helped other people set up. So one of the challenges is that, especially in the lower interest rate environment, like this one company in particular, they were having a hard time creating the returns that they needed to pay out the dividends and things like that, just based upon where interest rates were. So one of the things that they went to do was go to venture capital to get a big influx of cash. But to do
It's
that,
always
they had,
bad.
yeah,
Always bad. I
they had
remember
to
when, Blake, I have to tell you this. Sorry to cut you off. I remember when the first company that I worked with got a big influx of cash, and like 12 months later, they were out of business. Scary, right? Now,
that
I
is
will say
scary.
this. I say out of business. They weren't out of business. They still maintained their policies, and like
Yeah.
they so it's not like they left. They just left the business of doing new business and kept to the word that, what am I trying to say? They kept their word. They actually followed through on the promises that they were delivered there. But again, seeing that, like, when money gets influx that's not coming, like, not internal, that's always a little bit scary. Okay, keep going.
Yeah. So what happened with this company in particular is the individuals who owned whole life policies were the part owners of the company, right? So when they demutualized and brought in all this new money, myself and clients that I had were entitled to a portion of that revenue that came to the company. So everyone, depending on when you bought the policy and many different factors, everyone received a check. Some of the checks that people received, they were elated. They're like, I can't believe how
Yeah,
much
I'm sure.
cash I just got, like very
Yep.
significant sums of money just got sent to them tax free. And then I'll say this, the stability of the company was it actually went up in the ratings because of the amount of cash. So there was no concern over, are death benefits going to be paid? Is the cash value still going to be there? Frankly, I would say it would even went the other way with, now they have tons of reserves to pay out. So for a lot of people who were more death benefit focused, they loved this demutualization. They got a big check, and then they knew that their company had a lot of cash. On the downside to it, though, the policies that we set up that were, again, more cash value focused, what this company did, and other companies have done in the past, they said, okay, we're going to honor the guarantees, but all those dividends, those are going to be drastically cut moving forward. So as we ran in-force projections, essentially, it's like, okay, you were at X amount of cash value, then you got this big dump in to your policy because of the demutualization. But then going forward, all those dividends and kind of that gravy and growth that we were expecting and hoping for, that's not really going to be there. So it did create a situation where for some people, it wasn't a great situation, in the sense that they had this cash value and they needed to make a decision. Okay, am I going to cash out this policy? Am I going to stay with this current company, but at the reduced dividend rate? Or option 3 would be to move my cash into a policy with another company, using what's called a 1035 exchange, very similar to a 1031 in real estate, where you can take your cash value, move it into another company. It's all tax free. And then now I can set up a new policy with that company moving forward.